Okay, good afternoon, Dan, and thanks very much for working with YPN. I'd like to introduce you to the readers. We have Dan Taylor with us from Capital, and Dan's going to share with us today about a rather interesting business model that he operates for businesses and commercial real estate. So, Dan, over to you. Just first of all, if you could just tell us a little bit about yourself and what got you into where you are today, just so the readers can understand a little bit of the background.
Yeah, sure. I'm Dan Taylor from Taylor Capital. That's taylorcapital.co.uk, and we've been investing in businesses and commercial real estate for more than 30 years. And we completed over 41 transactions with a value of over £100 million, either completed, owned, or under development. And, so what do we do at Taylor Capital? We actually help two types of people. We help entrepreneurs grow, scale, and exit their business, while helping investors grow, protect, and scale their capital, investing in the best of British businesses and commercial real estate via our boutique private equity club called Taylor Capital. And principally, we target I suppose two types of businesses. We also target shops and uppers. We just completed a shops and uppers in Guildford. I think we featured that in YPN. It's got a GDV of 14 million. Great property and a great location, to be honest. But the two types of our core focus are business acquisitions. Business acquisitions where the underlying asset is the commercial property that's been traded from by the business. So the two types of businesses, what are they? On the left, which is what we're going to talk about today, in one case study in particular, are businesses in decline, where you can repurpose, reprofile redundant retail into high-performance, income-producing assets. On the right, the second kind of core focus are very profitable businesses. They've been around for 10, 20, 30 years, and the owners are doing over £500,000 profit, and we help them, what I call the kind of holy grail of exits, if you like. And hopefully they've got commercial property as well. And when a deal comes along where it's a business and it's a commercial property, that kind of gets me excited, because it's the two sides of the one kind of coin. But today, we're not talking about the big businesses. We're talking about, perhaps businesses in decline, where in that area, there's an alternative use, a different demand. And that demand, if you repurpose that redundant retail and reprofile that, you can create high performance income producing assets and get that massive arbitrage in equity spread by forcing capital appreciation. Yeah. Okay,
that's great. So we know which one that we're going to be focusing on today, Dan, which is smaller businesses in decline. And I guess that's very, very relevant and topical at the moment, given where we've just gone through in the economy with the pandemic. And I think also given what we are seeing in trends in the way that people have changed in their habits with the impact to the retail high street. And I think also, what happened with the planning changes that the government brought in last year about trying to repurpose the high street. So I think that's really, really relevant. So just before we get into some more of the detail, Dan, can you just tell me quickly, obviously you've been doing this for a while very successfully, but how did you get into this sort of model?
Oh, into this model?
Doing what you're doing today.
Yeah, well, I've always been in business. Never had a job, to be honest, and love being an entrepreneur. The highs and lows. So we've had highs, we've had lows. We've made a lot of money, lost a lot of money, and made a lot of money back again very quickly, as you learn from experiences. And how did I get into this? We started doing we did our first commercial conversion to residential, actually, which is really not my core focus, but even though I do it, that was in the late 80s, 1988 or something, 89. Okay. And then after that, in the early 90s, I kind of, what I call failed forward. We opened a number of businesses, didn't work too well. We learned a lot from it. And after that, kind of got back into my calling, which is, commercial real estate and businesses. And we did our first kind of, our first great project in 95 where we bought something for 117,000 and then sold it for 750,000, a couple of years later. And that really excited me because in that deal, even though we did very well, we left £250,000 on the table for the next guy, because
Very
it was
nice.
one strategy I didn't realize at the time, which I subsequently learned. And then after that, we kind of got involved, and we thought, great, 117, 750 exit, not too bad. Imagine we did that on a slightly bigger scale. And we started up at what's called a business roll-up acquisition strategy, which is buying small businesses that own their commercial real estate and ultimately gathering them together. Because small businesses are faced with severe problems that, as a result, they don't have a level playing field in the UK, versus the public sector. So public companies trade for 10 to 30, SMEs trade for on average 2.6. So, but buying, gathering up a number of businesses, you start to trade at different multiples. Therefore, you're accelerating values.
So that 2.6, could you just explain what is that multiplier, Dan? What does that multiplier represent for the SMEs?
It's a multiplier on profits. Now, profits is there's various different types of profit. There's EBITDA, there's no PAT, there's post-tax, there's pre-tax. So it really depends what you're talking about. But let's not go into that kind of detail. Let's just keep it a high level profit. And the average business in the UK, 91% for those that are on the market, only 9% sell. So out of every 100 businesses on the market, 9% sell. And when they do sell, they sell for an average 2.6 times profit. Yeah.
Okay.
Versus the public realm, they're selling between 10 and 30.
Is that more the data type situation?
No, just in a listed environment, you get a lot more because you haven't got the problems that small businesses have, which is kind of scale, liquidity, and legacy kind of thing. But the key thing is, we'll focus on the kind of business we're talking about today, and we've got a great case study that really shows the power of this. Is instead of right now, there's a lot of people going after the PD, and quite rightly so. There's a shortage of housing, which is a fantastic problem. And when there's a big problem, there's big opportunities. But a lot of people are after that market. And because of that, the agents are now realizing, PD, and they're baking the PD into a lot of these schemes when they're selling it. So they're taking a lot of the food off the table. They're already baking that profit in kind of thing, which is a bit of an issue. And we've really seen this in Q4 last year, where prices have risen and a lot of these deals are just not viable. And one area that's really, really viable is buying businesses where they own their own commercial real estate and that business is underperforming. It's maybe a business in decline. And for example, we bought one in Paisley, and which is west of Scotland, west of Glasgow actually. And this property is about, I think it's like 11, 13,000 square feet. I don't know, I can't remember exactly, but it's quite chunky, 3 stories.
That's quite big. Yeah, that is quite big.
Yeah, and it was on the market for 2 years, would you believe? Over 2 years. And interestingly, it was on a business broker's website. Yeah, and a national one as well. So a national business broker's website, this business was on for, and the business was losing money. So you have to, obviously, this is not a strategy you want to jump in with any kind of education, information or whatever. But anyway, I seen that, and I just seen one thing. Number one, I seen a huge pile of property for offers over 340, and we managed to secure that for 120,000.
13,000 square feet.
Yes, and then we managed to secure a tenant at 24,000 a year as well. So it's kind of kicking off 20% yield day one, but that wasn't really the big, the best play, because as soon as I went there, I realized one thing immediately. It kind of hit me in the face and nearly knocked me over because it was so exciting. And that was the fact that right next door, the Students' Union is there, where they go to socialize and stuff. Yeah. And then over the road was the university itself, University of West of Scotland. And the University of West of Scotland is a very good university, very, very busy. And on top of that, additionally, it's only 6 minutes on the train to Glasgow. So immediately I seen that, I just thought student accommodation, but this, which is absolutely in booming, and the business that was there was in decline. So you got one thing going in decline that we're picking up assets at pence on the pound, and you got another industry that you just need to, obviously go in with eyes wide open, and and then repurpose this property. It just so happens this one is it's grown into quite a large development, and we've also acquired the land next door to make a larger scheme. And we're going to be putting there 150 brand new purpose-built student studios, which is kind of like if you picture a boutique student hotel, it's kind of like that, but they're all studio rooms. Now, what does that mean? They're not HMOs. And there's a number of reasons why you would want to do an HMO. Nothing wrong with them, but studios have, with COVID in mind, it's kind of baking in the future, if any isolation events ever happen in the future. Because what is the studio? It's a self-contained mini apartment. Instead of an HMO where you have communal spaces for the lounge and the kitchen and stuff. Each studio has their own cooking facilities. Yeah, it also has communal space, but it's standalone. So it's kind of future baked in case anything ever happens again. God forbid, hopefully not. Touch wood.
And I think also, Dan, just to add to that, if I may, I think obviously you're targeting students for now, but I think having them individually would mean that perhaps if anything changed in that area with the demographics or the university, you've got something there that, you could still potentially do as residential, because it's still got that appeal, as you say, where we've been, people want their own sort of space, don't they? And also, just to clarify before we move on, obviously this one's in Scotland. Now, I'm not an expert on Scotland real estate. I know that the process works slightly differently. That's about as far as my knowledge goes. But I'm assuming, because you mentioned you did it in the UK, I'm assuming this sort of process, this methodology can be applied to whether it's Scotland or whether it's the UK. Are there any key real differences in what you need to do?
No, everything's the same. You're really looking at businesses in decline, which is UK, Western. It's just all over the place. So where do we have business in decline? It's sectors we're talking about. That's not geographically specific. It's sector specific. Yeah.
Okay.
So some businesses are going down, some businesses are going up, and you want to be in the intersection of that. To really make massive gains, because if you think about it, this one costs £120,000. Obviously, there's a cost to demolish and refurb, but the GDV on this one's going to be 15 million.
Nice.
Which is quite nice. Yes, could be a lot more than that, but conservatively it's 15 million, which is £100,000 per studio. If that was an HMO, that would be 75,000 per room.
Right.
Yeah.
Okay.
So you get obviously a negative discount when you're talking about HMOs for a number of different reasons. And also, when you're talking about the studios and something a little bit elevated in terms of an offering, we're really trying to lead the market in terms of living together to create this kind of student hotel thing, and which really opens up the market to the Far East, to Europe, who have higher expectations of what they should be living in. And
absolutely. And I think we've all seen, and I was having this conversation with a surveyor actually at a property mine earlier this week, that which happens to be in a HMO, that what maybe students years ago would have accepted as being an acceptable standard, is, some of them sort of wouldn't want to use that as a kennel for the dog these days, if we go back to what some of the standards were many years ago. So I think expectations on standards, and I know that the international students, because that potentially most of them have got bigger pockets, their expectations are even, so much higher as well.
Yes, well, in this area, because obviously you don't just jump into these things, you have to do research, and part of the research is getting to know the university well, and trying to find out where, number one, where their occupancy levels are, number two, where the big demand, the growth and demand is going to be in the future, And really, where there's demand, you should supply demand. Never kind of do a Kevin Costner and build and hope the demand will come. Make sure the demand's there first. So the big demand seemed to be from China. And the Chinese want to put 300 students through Paisley UWS, University of West of Scotland, per year, but only for 1 year. So they're educating them in obviously China, and for the last year, the fourth year, they want to kind of finish them off in Paisley, and every year send 300 new ones. So it's kind of designed with that in mind. They have a higher expectation of what normal is, kind of thing, because they're quite affluent. And we want to provide that, but by providing studios, you also have the post-grad market. Yeah,
absolutely.
And where UWS, they owned a lot of tenement blocks, the old tenement blocks, where the old stone steps that keep going up and up, and it's kind of curved like that because there's that much traffic's been over the last kind of 80 years or something. And they're the last stock to get filled. So new build is always the first to be filled. Studios first to be filled. Closest to the university, first to be filled. And we tick all those boxes. So it's a really exciting proposition, but it's the kind of thing anybody listening or reading this article could get involved in. And why is that? Because this business was on the market for over 2 years, sitting there. It offers over £340,000. A lot of people came to kick the tires, but you've got to go with glasses on of what this could be as opposed to what it is, kind of thing.
Absolutely. Yeah? And interestingly, I think what was quite key that you mentioned, I picked up on, is that this was originally advertised on a business broker's website, not necessarily maybe a commercial agent or a right move type approach, which perhaps some people wouldn't think of looking at if they're trying to locate property, for example. Dan, I suppose it's looking at things differently, isn't it? As I said, it's taking those glasses off and looking at things differently.
Yes, absolutely. And, as soon as I seen it, which was 2 years later after it got listed. So, I was even doing a bad job because I should have seen this. But I thank goodness I never seen it before, because it allowed a lot of people to come through, kick the tires, realize they're going into a loss-making business. And so therefore you need to know how to turn that around very, very quickly.
Right, okay.
Yeah. So, and how we turned it around is we took a lease option, which this is why I'm saying anybody could do this. On the market for over 2 years, offers over 340. We got a lease option for £120,000. And what is that? It means we're taking a lease of the premises. It was for 5 years. It was £15,000 a year rent. Yeah, and day one we had a tenant, and a small part of it, that there was a cafe was part of this business, and we rented that out for £15,000. There was kind of no money in, no money down, no rent to pay, while I came up with the game plan, the real game plan. And as soon as I rented the cafe out, I also rented the rest of the space out as well to the manager. So it was a lease option with MBO, which is a management buyout of the business. Yeah. While I worked on the bigger plan. So,
and I'm assuming, sorry to interrupt, the bigger plan was then starting to look at getting the plans and things drawn up for the purpose-built student accommodation.
Yes, absolutely. And what that would look like, what the demand is, to give me no hassle, no involvement with that day-to-day running of that business, because the manager now owned the business. Yeah. And which freed me up to then, go and investigate what the demand is. Not just how many units do we need, who are we serving, who is the most likely customer going to be, and what do they expect, kind of thing.
Yeah, absolutely. And how long did that process take you? So you put the tenant in. What term did you give them on the lease, Dan?
I gave them 5 years.
Okay, so how would, just sort of starting from the beginning, because obviously at this stage you wouldn't have known what plans you were going to end up with ultimately. If you put somebody into something and then you've got to demolish it, would that been a little bit of a challenge if you've got a tenant on a commercial lease for 5 years?
Well, you obviously need a ratchet in there, a mechanism whereby you can gain access. You can take, that property back.
Okay.
Yeah, so you always need to accommodate at some point in time the ability to take that back off the tenant, which is built into the lease.
Okay, so whether that was a break clause or something like that, you've made sure you covered that off in the tenancy. Okay, yeah, just a quick point, because I know people go, no, if it's on a lease, or what can we do? And so just to make sure we're getting that point out for people.
Absolutely, and we don't. I mean, he bought the business. You know, when we take the property back, we will be helping relocate him to another property.
Okay.
Yeah.
So it's a bit of a win-win. Yeah.
It's always a win-win for me. You know, you never do deals where somebody comes off worse. I always like to do deals where everybody wins, kind of thing. It's more of a holistic approach to deal making, you know, and it's really putting yourself in the other person's shoes. You know, as they all say, walk 1,000 yards in the other person's moccasins or whatever. You know, look at
somebody else's shoes.
something like that.
That's what you mean, Dan, I think. Yeah,
absolutely.
Yeah.
Yeah.
So take us through a little bit sort of about the process. Obviously, I think we all sort of got some familiarity with planning these days. It's taken quite a long time anyway, but just talk us through a little bit about the process on this particular one, if you wouldn't mind.
Yeah, well, the number one process was assessing, you know, what is the demand, what's the alternative use that it could be, and going through the various permutations. Student accommodation was not the only thing we hung our hat on. We were in the discussions with Co-op Food to take the whole ground floor, and half the first floor. We're in discussions with Papa John's Pizza, Domino's Pizza as well, actually. You know, so we were investigating a lot of different routes, and you know, and along the way to seeing what kind of appetite, what kind of demand was there. And then you've got to assess that demand. What does that end value look like? And what's the cost of achieving that end value? When I look at things, I try to look very like Japanese long-term thinking. You know, some people think a 5, 10, 15-year lease to, for example, a Co-op Food, which we have Co-op Food in our stable, or even we've got a 30-year lease to Witherspoons. We've got a number of different nationals we have on very long term. The longest lease we got is 35 years, no breaks, would you believe? And that's to the government. And it's pretty cool. So I try to really think long term, why? So there's no hassle, and to really force those capital appreciation. Yeah. So when I was thinking about this, I'm always assessing each outcome, not just on value, but how much hassle is going to be going forward. Yeah. And how much forcing of capital appreciation we're going to get to do one thing, to decrease the risk. Because the less gearing you have on an LTV basis, the less risky your whole project's going to be.
And clearly, the longer the lease, and somebody like the government or the big names actually increases the covenants of your lease as well, doesn't it? Yeah, has an impact on the value.
Yeah, absolutely. But this one's slightly different because we're going to build this, and you know, it's going to be one of our operational ones where we bring in a national company to manage and operate. Yeah, but we get the revenue kind of thing. Yeah, they take a percentage off the top line, and we get the rest kind of thing. So, but student accommodation for me with this location, because obviously properties, location. Nobody can leapfrog this location because of the moats or the infrastructure around this location. We're next door to the Students' Union. We're over the road from the university. It cannot be leapfrogged. Yeah. So nobody can get a better location. So for me, it's a very long-term hedge play to create, you know, consistent income over many years. And the income, just to give you an idea, is just over £1 million on this, which is quite a lot from one box. It's quite nice.
Incredible.
Yeah. So back to that next steps kind of thing. So next steps, when you get your plan, your alternative kind of use, what the best plan is for the long-term thinking, or whatever your play is. Your play might be a capital event, you know, buy to add value to sell kind of thing. For me, you've got to have both. You've got to have kind of 3 buckets going in your life. You've got to have an income bucket, a capital bucket, and a legacy bucket kind of thing. Maybe we touch on that another time, but
totally agree. It's what we call mixed streams of income, isn't it? You've got to have that balance no matter what you're doing. You've got to have your cash flow. You know, you might want some chunks to do things with. You've got to get some capital appreciation. You've got to think about your longer term. So, you know, there's lots of different boxes to think about, Dan, isn't there?
Absolutely. But the next step for myself was then obviously speaking to the the stakeholders, Paisley Vision, the planners, the councillors, UWS themselves, and make sure everybody's kind of bought into this transaction kind of thing, or what it could be, the vision of what it could be. And then after that, you kind of start, you're on your scaling, massing with the project kind of thing. And after you've then got the architects through phase one of design, we then bring in our QS, our quantity surveyor, to try and make sure we've got the pricing. Because the first thing we designed, we had a GDV at the time of 12 million, and our cost base was 11.7 for construction. So clearly,
not the typical model then that a development company would or a lender would find attractive then, Dan.
Yes, absolutely, because it had all the bells and whistles on this development, and then obviously bringing in the QS, you then get to the point of view of, okay, we've got a cake. Let's amend the baking of that cake. So number one, we've got to push the GDV higher, and number two, we've got to reduce our costs, which sounds like a contradiction, but with efficient design and a reduction in certain things, you can quite easily get there. So we're now at 10.1 million of a construction cost and 15 million GDV.
That's a bit more healthy.
Absolutely. So happy days. We're kind of there.
Do you work with, you mentioned investors when we first started. Do you work with investors on your schemes, Dan?
Yes. Well, we've got a kind of boutique private equity club with our members who are investors, and we provide education insights, investment insights, and also we provide a mastermind for all our investors to take them on 30-day sprints. So okay, what was the game plan this 30 days? What went wrong? How did we fix it? Those kind of things, and we dive into various different topics. Each 30 days kind of thing. And our first raise this is not it's a crowdfunding website, but it's a closed door crowdfunding website just for our club
within
members.
The private club. Yeah. Okay.
Yeah, and the first deal we raised was 5th of November. The deal completed. It was Guildford, and it cost 5.1 million. It's got a GDV of 14 mil. And we might actually exit that potentially, depending on the numbers. We might turn that instead of a long-term income play, we might turn that into a capital event with the benefit of planning.
Right. Okay. So just as a matter of interest, because obviously there's lots of different offerings out in the marketplace now for finance. You've got your typical development routes, you've got your crowd, you've got your crowdfunding platforms, your peer-to-peer. Is your setup registered, or is it just because it's a private club? It doesn't work in a different way, Dan? Because it's just people privately within that environment.
No, in that transaction, we took in 26 investors on the one project. And when you're doing these kind of things, you're in a highly regulated kind of compliant industry. You Absolutely. Have to. We like end of last year, we were trying to buy a crowdfunding platform, and for one reason or another, it kind of fell by the wayside. And I, beginning of the last year, 2021, I decided I'll just create my own. How hard can it be? How wrong can you be? It was hard.
Did you spend ages engaging with the FCA around this sort of stuff?
Well, the biggest time, January 2021 is when we started developing. The 6 months before that, we actually did, going down compliance kind of roads, potential compliance roads that we could actually do to provide this kind of club platform. And we finally decided on our route, and then we started developing in January, and it was ready kind of July or August or something, and that was the first raise we did, for the November the 5th acquisition. But it's a huge area. It's one you got to get right, and every step of the way through our fintech platform, there's compliance built into the thing. Even for we've got our own HNW sophisticated sales certification. We've got KYC, KYB, AML. We've got proof of funds all built in.
Yeah.
We've got a loan wizard that then, if it's a SaaS pension, for example, you fill out your bits, then it gets pinged to your SaaS administrator, then it gets pinged back, and everything's time stamped, and it took forever and a day to build. And cost.
I can imagine, Dan. Yeah, I mean that in itself is a sort of a whole article, isn't it? So okay.
Yeah.
So where are you at now with the Paisley one? What stage are you at now with that particular project?
We've had our pre-app in, and that's all fine. A pre-app is like an outline planning permission, yeah. So it's not a full detailed planning permission. And next week we're ready to submit the full detailed planning application.
Okay. And how long do you think that typically is going to take you? I mean, the bigger schemes we know take longer because, they might be more things to go through and committees and, objections and all that sort of stuff that you have to deal with. So what's your expectation on timescales, Dan?
Well, right now, whatever I say, I'm going to be wrong. I mean, we've been forever and a day with the Guildford one, and we've had the PD approval. There's 3 planning applications there, and we've just had our confirmation that the third one has just been given the green light. We haven't got the approval, but we've just been told that we've been given the kind of green light on that one, which is great. So we can build either 20 or 25 apartments in Guildford, which is a high value area, but that has taken a long time. And nothing's ever going to plan right now, and why is that? Well, Guildford, for example, during the pandemic, obviously everyone's working from home, and they continue to do so to a certain extent. But during the pandemic, they had 800 additional applications, more than usual, extensions, this, that, and the other, government offices that are just go for the planning, requirement for a planning kind of application. So they're inundated, they can't cope, they don't have the bandwidth, it's happening all over the country, and there's a backlog. So there is an approach that we used in Guildford, which is we paid for an additional, after paying for the planning application, we paid an additional fee to have somebody else work on behalf of the council to actually, do the planning permission, actually look at it.
Really? That's interesting. I've not come across that before. And did the council clearly were okay with that? So
well, it's within their department, to be honest, but because you're paying twice for the same thing, they put focus on it. It's called a PPA.
Okay.
Yeah. So and it's not for PD. This is pretty much just for major applications. And back to the Paisley one. From what we've heard from the council, it could all be done and dusted in 6 months, but we have earmarked a year.
Okay. So anything outside that year is really a bonus to you.
Yes, absolutely. And if it doesn't, so more likely be 6 to 9 months, but we've got a year earmarked there. And at that point, we might open that up to members of the club as well to get involved in that project if that's the kind of thing they want.
It's interesting you talk about the mastermind group, the 30-day thing, because, I see so many things out there these days that people call it, lend and learn, there's all those sorts of things going on. You see different schemes. We do something within what we're doing called invest to know and grow. So if people want to work with us, they can do a similar sort of thing because everybody's got different requirements. So, and the great thing is about your Paisley one, it doesn't really matter how long it takes because it's not costing you anything, Dan, is it? You've got the tenant in there paying rent, so happy days.
Yeah, and there's no debt on the thing either, which is unusual. So we're in a position where there's no debt. 20% returns coming in. So the real risk starts when we start demolishing because we've extinguished that income. But obviously by that at that point we've got planning permission, so we've enhanced the value massively.
Absolutely.
Yeah, so it's an exciting time for that one, and it's really the whole of Paisley is. I mean, I love regeneration projects. What we do, we call it urban alchemy, and right now Paisley is going through a huge regeneration scheme because either side of Paisley there's 2 shopping centres, like mega stuff with the full retail experience, the restaurant experience, the cinema experience, one either side, £150 million developments that's absolutely quashed Paisley 20 years ago, and it's never recovered. If anything, it's got worse, obviously. Vacancy rates are probably some of the worst in the UK. And this site that we purchased was recognised in the Paisley Vision Statement as a very highly visible site that really needs a lot of work done to it. Because over the road, we're kind of paying homage to the £60 million development, an investment the council's making in the library, which is huge. Just down the road, the shopping centre is literally going to be demolished and turned into, a brand new residential quarter, which is quite exciting. So we're kind of the bit in the middle that's kind of bringing it all together, and to really, do some, to get involved in these kind of projects when you're creating real impact in the local economy, the townscape, for future generations to come, is really exciting for me. It's something that kind of lights you up,
So obviously not everybody can start the level that you're at, Dan. It's obviously something you've done and you've grown over the years. So what would you say to people? What advice would you give? Because obviously there's, I can go to certain areas and look at it and you think, oh, this is dire, and there might be plans, and, you can see the way that some of things are going. So if somebody was interested in doing this that hadn't got your experience, I'm assuming that you could scale this down to start with if you wanted to look for this sort of project initially. It wouldn't have to be something as big as the Paisley one. Assuming there's the smaller projects out there that people can start with and start to move forward on this sort of strategy.
Well, just think about it from the reason we're going over this particular case study is anyone could do this case study. Anybody. It's 120,000. The price of a one-bed flat.
Purchase price, yeah, absolutely.
Yeah.
Within reach of those people, yeah.
Yeah, and it's 20% returns day one if you have a little bit of common sense. Wait until you find out what the game plan is. So imagine if you've got no money and you found this transaction, 120k, you negotiated the price down to like I did. You got an investor £120,000. You paid for the whole thing cash, and you got the tenant in through what we talked about, a 5-year lease. They're paying, they're paying 24k. The investor can get 10%. You can get 10%. So you can both get £1,000 a month each.
Right. Okay.
Yeah.
Okay.
And then when you get your planning down the road, you can pay the investor off, or you're 50-50. It's a kind of deal that anybody can do, and it's why I was quite excited to share this one, because it's so achievable in terms of value. Now, if you didn't want to do the big scheme, because that's scary, then, what you would do is you would get planning permission for the big scheme and sell it.
Sell it as a planning game. Yeah.
Absolutely.
Developers,
And that's the less risk, the very least amount of risk. Now, if you wanted to retain the property for income for longer term, number one, you've got a tenant in place. But it's a risky tenant because it's a local trader. So that, for me, that's high risk. I love local. I love national high street brands. I love them both, but it really depends on the person. But number two, imagine you wanted to add some more value, that you would just convert the existing building into student accommodation.
Right. Okay.
Yeah, and you wouldn't have to do the whole building because our tenant.
Okay.
Well, don't knock anything down. Just leave the tenant on the ground floor and convert one floor at a time.
Okay.
Yeah.
So there's this would be the perfect project for most people because, as you say, there's so many different approaches, there's so many different exit strategies that you could take on this one. So yeah, I think that's it's a perfect case study for people to say, look, because price point wise, we're not looking at 12 million or 1.2 million, we're talking 120,000 purchase. I mean, I'm not sure when we get much like that it's sort of south of the Scottish border down at the moment, but there's got to be deals out there. So I know obviously this business was in decline, that it wasn't a viable business. So what about if you come across something was trading, although it maybe wasn't doing that well, what sort of guidance would you give about approaching something that perhaps was somewhere in between this? They've got the real estate, there is a bit of a business, although it's not doing that well and they want to get rid of it. How would you approach something like that?
Well, for me, buying businesses on their commercial real estate is great because you're paying a multiple of profits. And if it's not profitable, and that includes the commercial real estate, it includes the plant and equipment, it includes the moving parts, the assets and the liabilities kind of thing. Depending, you may be just buying the assets, which I tend to do. So you're just buying the assets and you're leaving any bad stuff behind. And what's weird about that? Well, number one, it's commercial property. Has there been any capital allowances claimed? More likely not. Number two, there's a whole load of plant and equipment that you're buying in there as well. You can claim allowances on those as well. So there's a hell of a lot of tax advantages going on. Like, for example, in Guildford, when we did our capital allowances claim, a lot of the capital allowances guys we sent in to give us an idea, they said 300,000-400,000. And then we started to think, well, have you claimed for the turning circle? A turning circle at the back is you kind of drive in with a van and the circle turns so that the back of the van is now at the back door of the shop, It's one of those quite a big, massive expense to put these kind of things in. And, the first chap says, no, we haven't claimed for that. We have no experience in that. Fair enough. But that's no good for me. It means you don't know what you're doing in your job. So we then find, obviously, I've got 5 guys I work with. We managed to get the capital allowances claim to 900,000. And what does that actually mean?
Yeah,
it means we can have 900,000 profits without any tax at all.
Any tax, yeah. And to pick up on that, you are so right. There are so many people that do not understand or utilise capital allowances. I even did it a while ago on a HMO. It's more difficult these days than the smaller ones. We did it on a property we did in Wales. And I'm funny enough, this week I got offered a commercial building with a response to one of our campaigns. Somebody said, well, the building's 3/4 full, but if you want to make me a reasonable offer, then I'll listen, but I'm keeping the capital allowances. Well, I wrote back, that wasn't more than we were after anyway, because we want to develop. So that's the first time I've really come across somebody that's been sort of a bit clued up about capital allowances. And as I said, people just do not realise the benefits of having that if it's not been utilised before. And that's all part of your due diligence process, because you have to have approval, don't you, to carry that capital allowances benefit forward.
Yeah, the interesting thing in Guildford, though, is we were dealing with Aviva. Now, Aviva is a big fund, huge pension fund, multi-billion-pound pension fund. And they usually have everything like claimed left, right, and centre. But we managed to find an additional 900. Now, this is after they've had a professional in to claim, years ago.
Really? A capital allowance specialist has missed 900,000?
Yeah. So there's some... Scary. It's just like anything in life. You get some people who are good, and you get some people who are great. And the variances there are massive. So it's worth having a number of different capital allowances specialists in your team to call on, because some people have experience in sectors. Yes, they have experience in capital allowances, but maybe somebody's more industrial, maybe somebody's more retail, somebody's more mixed kind of urbanization schemes. Who knows? But we use a number of different ones, and they're all good for various different things.
Okay, no, that's really good advice. And it's like anything and anybody in this game, whether it's a broker, whether it's a solicitor, whether it's some are better than others, and as you say, depends on the background and the experience. So I think that's really, really great advice. So I'm just getting a bit conscious of time. So obviously you've got your hands full at the moment, Dan. So have you got any more in the pipeline in the UK at the moment? What's your next step?
Yeah, we're negotiating with a number of that was, remember at the beginning we said we deal with really 3 types of property. One, our businesses in decline that own the commercial. One, our businesses that are very profitable and own the commercial. And then the third one is obviously pure commercial plays. It could be a parade of shops and uppers, that kind of thing. Where we're looking at one that's an investment just now. So it's got a national brand in there, a large property, 45,000 square feet. And but it's already rented for the next 19 years, and it had not much vacant space, so it's already been rebased, so the rent's been rebased, kind of thing. And so we're looking at that as what's the alternative.
How would you look to add value? What would be your angle? Because you think, oh well, it's got somebody in there, it's fully occupied, it's been utilised on the rents. What most people wouldn't see the angle on that. What's going to be your angle on that one, Dan?
Well, two principally. Number one, you lock your in that kind of deal, you lock your value in when you buy. So you have to be buying at a certain cap rate or yield. Yeah. So that it's
Okay.
and then obviously after that, after 5 years, there's rent reviews baked in. They're upward only, linked to RPI. So there's another good thing. There's some potential on the roof, not to convert to resi because resi is not high enough value in the area. But there's potential for other, believe it or not, tenants. And then on, I think there's about 5,000 square feet that's vacant. So you've got extra kind of value add there. But really, for that kind of thing, it's you've got to think, okay, 19 years sounds like a long time, but what are you going to do with it after 19 years? And so, that's the game plan. That I know exactly what we're going to do with it. And hopefully we don't even get to do that. They just, re-sign another lease. But so you're buying the value in day one there, and there's a few extra things to really tweak that cap rate and get extra growth. But a real focus of ours right now, and we've been negotiating with a lot of businesses, is helping small and medium business owners. We're trying to buy some businesses that are asset heavy just now, that also in the commercial property, that are profitable, been around for 10, 20, 30 years, survived 3 recessions, and they're making over £500,000 profit each. So we're right now negotiating with a number to acquire the whole business and the commercial property. And then one thing you can do with that kind of business is just do a simple sale and lease back. You've added a ton of value. Yeah.
And can you do that with commercial leases? Because say for example, if we look at the equivalent on a residential basis, if you like a tenant, if you've got a tenant or you've got an owner that wants to sell something, you can't actually buy it and then put the tenant back in these days. They stopped doing that a long time ago. So is what you're talking about a similar sort of thing going on commercial, Dan? But
yeah, well, there's a number of different things. There's one where you have your a property and you're putting national high street brands in there on long-term leases. Yeah.
Okay.
So that's one strategy I kind of do that's really it's quite profitable. But the most important thing, you're forcing massive capital appreciation, which means you're de-risking the whole thing, which is really important to me. But on this kind of strategy, what we're talking about is buying trading businesses. They're asset heavy, commercial property heavy, and when you buy them, separating the lease from the trading business from the property with a long-term lease, just the simple act of doing that adds a ton of value. Yeah.
Okay.
So imagine if you're buying a business for, say, 3 times, to keep it simple. Yeah. And it's £1 million profit. So you're paying £3 million for the thing. Yeah.
Right.
Now in there, if it's £1 million profit, the property is usually quite big. So say the rental is £300,000. Yeah. So say you then put a rental in of £300,000 for a 20-year lease, then your profit's down to 700 over here. So it's only worth 2.1. Yeah.
Right.
So it sounds like you've lost £900,000 of value, but over here you've got £300,000 of rent that's worth about $4.5 million.
Okay. So this wouldn't be the original owner that was running the business. Would this be this would be a different tenant, would it?
No, this would be us acquiring the business.
Okay, so you're buying the business from them. Yeah.
Yeah.
Okay.
Yeah.
Okay.
So really, I call it ABCs, acquisitions of businesses and commercial, as such an incredible space because of the values you're buying it, the multiples you're buying it. Yeah. There's one business we're looking at right now. They have, they're doing 2 million EBITDA profit, and they have a big box, 45,000 square foot box where they operate from. But the land is incredible. And as soon as I see the land, I get excited because it's roadside. And I can see a Starbucks drive-through there. I can see a Subway. I can see a Domino's. This kind of thing. Right. So I'm kind of coming into this, business acquisition, thinking, what can we do with the land? Yeah,
right.
Because there's a ton of land there. Easiest thing to do would be put another 2 45,000 square foot boxes when they get pre-let.
Okay.
Yeah? Which would pay for the business. So you're kind of getting the business for free at that point.
Right. Okay. So very creative and. Lots of opportunity within there then.
Yeah, it's not for everybody. It's not easy, to be honest.
No, I can imagine it doesn't sound, some things sound easier than others, Dan, but it's like anything, it's not always that easy once you start to get involved with some of these things, is it?
Yeah, no, it's the kind of thing we don't suggest our club members do. If they do want to do, we help them through it. Our investors, but really, it's an opportunity for them because every investor, like a SSAS pension owner or something,
Yeah.
somebody's had the sense to claim back their pension, a traditional pension, and put it under their control as like a business pension called a SSAS pension. And the great thing about a SSAS, well, there's a lot of great things about a SSAS pension, but when you've done that, it's usually busy professionals, solopreneurs, or business owners that don't have the time then to then go and invest that SSAS pension. Yeah. And they just don't have the time to go and do the deals. They don't have the time to do this. And really, if you think about investing on simple terms, if you follow some of the greats on the planet, like Ray Dalio, for example, he has principles in investing. One of those principles is called the Holy Grail, or he calls it that. And the Holy Grail, simplified, is really this. He says you only need 15 to 20 bets or investments, as he calls it. And the more uncorrelated they are, the less risk, therefore, the higher return you're going to get. Yeah. So the more uncorrelated they are, the less risk and the more return you're going to get because less of them will go wrong. And yes, investments, some will go wrong. But the more, so if one sector doesn't do well, it shouldn't affect every other investment you're in. So what we do in our Boutique Private Investors Club is help investors through deals, but we also help them invest in deals that they like, that we bring to the table. And so we're providing a kind of holistic, a diversified approach to investing your SSAS pension when you just don't have the time.
So obviously that's that's one approach. That's a hands-off where you work with investors that don't have the time to do it. Obviously, we'll have quite a few readers, from YPN that are, active property people, want to find their next project or find their next investment, and they might have some people they're working with. So, sort of thinking on that sort of level, what would be the advice to somebody wanting to start with this sort of strategy, Dan? What would you say to them? What fundamentally, where would you say to go? What's some quick, simple rules for what we've talked about if somebody wants to get into this sort of stuff and do it themselves rather than being an investor?
Yeah, well, just one simple thing. Everybody's looking in the same places. Yeah.
Okay.
Just keep looking there, but also add something else on where nobody else is looking. Why was this property not sold? Because it was on a business selling website. Yeah, it was a national company, a regional company, huge company. So start subscribing to big companies that sell businesses that also own their own real estate. And then all of a sudden you'll start to get things coming up that look quite interesting. And whatever the sticker price is never the sticker price. If it's a business in decline, if it's a business that's producing great profits and it's for sale, then they will get the sticker price. They're very, not a million miles away from it. What we do for businesses, that are profitable is we never go through brokers or agents. We always deal direct to vendor. Yeah, always. Because you're dealing with somebody that has not even thought about an exit plan, has no expectations, their mind's not being watched by the broker on unrealistic expectations. But on the other side of things, what you're looking for at businesses in decline, where you're trying to repurpose and reprofile redundant retail into high performance income producing assets, what you're looking for is businesses that have been on there for a while. And they also have that commercial property and they're in unsexy sectors. Yeah. Who goes bowling anymore? We turned a bowling alley into a parade of blue chip brands. Snooker hall. We turned a snooker hall. Who plays snooker anymore? I don't even know anyone. A lot of bed and breakfasts, have turned into the new Airbnb, mini hotels.
Service accommodation, absolutely, which is sort of huge again at the moment, bouncing back after lockdown. So, I agree with you. It's perhaps, as you say, looking maybe where the masses don't, basically, I think is the message, Dan, isn't it? Yeah.
Yeah, absolutely. And another one was a trailer park. It's getting turned into self-storage because that's a booming sector.
Right. Yeah. Storage. Yeah. No. Yeah. I agree. All these, these jumbo dot storage things that have popped up all over the place for whatever reason.
Well, this is self-storage with just containers.
Okay.
So, shipping containers. So
right. Okay.
what's great about that is the great thing about that is you can rent your first 20 to see if the business works.
Yeah.
And if it doesn't work, you haven't hardly got any skin in the game. Yeah. And if
Yeah.
it does work, you can then build to order.
Right.
You don't need 200 containers day one. You can kind of build to order. So it's a great model. And again, that's buying businesses that own the land. Yeah.
Okay. Very, very creative stuff. Yeah. I think this is going to sort of set a few minds racing down. So thanks for that. And when you're not doing all these amazing things with adding value to these businesses and these buildings, what do you sort of like to do in your free time, your downtime? How do you chill and manage the contrast of all of this?
Well,
you seem quite laid back, actually.
I am pretty laid back, and I think Richard Branson put it best, where he said, when life and work merges into one, and it's just life, that's when you're doing something you love. So
okay.
when we go for walks, my wife and I, we're in Puerto Banús just now, which is on the south of Spain, and in the morning,
yes, nice.
in the morning we go for a walk. And we, that's our board meeting, walking along the beach.
Okay.
And we're talking about, a lot of things, life, family, business, all those things. And then after that, we jump on, do my calls, whatever needs to be done, chase things up. For me, it's all just the one thing. When I'm talking about business, I'm chilling. When I'm in the bath with a bottle of wine with my wife, I'm chilling. We're talking about whatever. It's all kind of blends into one. And that was always an objective I had, where years ago I had a business that had, nearly 300 staff, and I was anything but chilled. every day brought another issue. That was, and after that, I kind of mentally focused on, okay, let's buy business in decline. Let's, put somebody in between me and the customer, which was National High Street brand, which put them in between me and the customer, and also forced the capital appreciation massively. But it basically gave me one thing: multiple diversified long-term income streams. And when you've kind of got a number of those going on, life becomes more relaxing, and you start looking at transactions. Do I really want to do that? Is that exciting? Is it fun?
There's more choice, isn't there? I think when you get to a certain point down, then you do look at things differently. Do I really need this? Do I want it? No. So okay, maybe that's not quite right for me now. So I do think it gives you more choice, and everybody these days wants to talk about that lovely laptop lifestyle sort of thing, and it's just getting to that point where you can do that, I think.
Yeah, and absolutely. And rule number one for us is always look after investors. Number one, number 1, 2, and 3. They are the guys that we look after. So that's why we think about projects and we look at hedging. Okay, how can we hedge this in multiple ways? How can we de-risk it? Because we're rule number 1 is return of capital always. And for me, I always de-risk, because I'm a kind of de-risk kind of person in my mindset. I'm 56. That when you get to past 50, you start thinking about less risk. But I'm
with you on that one. I'm there, Dan. In fact, we met a vendor this week, and it's given me some great ideas talking to you. And he's he's a lot older than that, and we looked at what he'd got and where he was, and he shared some personal things with us, and we gave him some advice, because he's had some challenges, and we said, look, whatever you do is don't fix what's coming up for expiring for too long, because you lose the flexibility of wanting to change things. So things do change as you get older, and I think you've got to assess things in a different way. So I think that's absolutely spot on advice, Dan. So thank you very much for that. And it's a conscious of time now, so thank you very much for your time. It's been it's been enlightening speaking to you. I'll let you go off and enjoy the sun in Porto-Banús now. And if you could get the details back to us, I'll share this with Jane, and then I'm sure she'll be in touch. So just to let you know, we'll pull it forward to April. I'm sure we'll have enough to do, a really informative article for that. So it's been an absolute pleasure speaking to you, and thank you so much. I've learned so much, and have a great afternoon.
Yeah, Julie, I really appreciate your time. Thank you very much, and look forward to our next chat.
Yeah, absolutely. You take care. Thanks, Dan.
Thanks. Bye.
Bye.